We have arrived now at number 23 of the contributions to this conference. We are glad to have now here Mathieu Charbonneau with his presentation. He is a PhD student from Carleton University, one of the few sociologists here at the conference, and he'll tell us something about insurance. And the title of his contribution is Towards a Political Economy of the Insurance Industry. That's your turn.
Thank you very much. So hi everyone. Before starting, I wish to thank the organizers for accepting me to give this talk today. Today I invite you to explore with me why capital as power approach offers, in my opinion, on which one can study insurance capital, mode of power, and dynamics of accumulation. As you will notice, since I'm just starting my second year of PhD, I will simply be offering an exploration into this new empirical site for capital as power approach. Interestingly, outside of standard historical studies, orthodox economics, finance, and management, the insurance industry has been, in my opinion, again, highly neglected in social sciences and especially in political economy. As a matter of fact, this neglect might well mirror both the pervasiveness of the industry as well as the opacity of this core institution of capitalism. So my agenda, I will start by offering brief remarks concerning some insights offered by regulationists concerning private insurance, but I will focus after that on the sociological controversy over the insurability of catastrophic risks. As we will see, this analysis of an extreme form of insurance will actually shed light on the case study of terrorism insurance. And I will suggest that this controversy has allowed to establish an ideal type, or if you will, an archetype of insurability, and thus to move beyond the strict actuarial probabilistic notion of risks and insurance. Moreover, I will conclude by suggesting that the study of insurability points to the possibility of approaching the political economy of the insurance industry through the theory of capital as power, since insurance capital's mode of power and dynamics of accumulation are based on essential state collaborations, on intense strategic sabotage, and on powerful reordering of society. So let's start quickly. As with most approaches, as I just said, in political economy and heterodox economics, regulation school has neglected to focus precisely on the insurance industry. Why do I talk about regulation school today? Because in my opinion, and also in Bernard Chavance's view, regulation school intersects up to a certain point with institutional economics and thus with capital as power approach, although partly based on strong Marxist premises, as it offers a power-centered institutional approach. That being said, I found some insights on the insurance industry in the works of Robert Boyer and François Chenet. First, Boyer quickly mentions that the insurance industry greatly contributes to the liquidity of the interbanking system, and in that way, private insurance hence appears to be at the core of both the monetary regime and credit system in capitalist economies. As to François Chenet, he traces back the origins of financial capital centralization back to the 1950s. For him, financialization represents an indirect consequence of the capital accumulation that has occurred during the Golden Age period, or Fordism as they call it. Promoted by fiscal incentives, the richest among the households of middle class and upper classes have started to use their extra saving mainly in order to buy life insurance, and that before the rise in pension funds. Consequently, even, and I quote Chenet, consequently, even today, the insurance firms are the biggest owners of financial assets. And I add, in most industrialized economies, some of the most powerful institutional investors. While they have been the leading actors in terms of assets volume, insurance firms are now being closely followed since the end of the 1990s by investment firms and mutual funds and pension funds, which assets have been steadily growing at a faster rate. Okay, I will skip a little here. Concerning the regulation school, to sum up, the study of insurance industry represents a major gap in regulationist literature, but regulationist analysis nonetheless timidly point out to private insurance as constituting the core of the globally dominant capital. So that being said, let's move to the controversy over the insurability of catastrophic risks, which I consider as the moment of birth of the sociology of insurance, which is an emerging field in sociology, but also as the first insights into a critical political economy of private insurance. Just long story short, during my master's thesis, I became interested in the risk society theorist Ulrich Beck and in his private uninsurability principle. I will explain later. Formulated for the first time in 1992, Beck considers this principle as the institutional indicator of the shift from the industrial and national first modernity, as he calls it, to the second modernity of global risk society. That is not that interesting. What is interesting is that, according to him, and to this principle, the insurance industry would actually refuse to insure global, irreversible, and unmeasurable catastrophic risks, thus conflating all types of catastrophic risks like industrial, technological, even financial, and terrorism-related risks. It is precisely the case study of terrorism risk insurance that has fueled this controversy between Beck and Richard Erickson, former critical criminologist at U of T, who passed away a few years ago, and Aaron Doyle, with whom I am working with at Carleton currently. But first and foremost, this debate has allowed sociology to tackle the issue of insurability by asking the simple question, what is insurable? So let's have a look at quickly at this debate. But before doing that, just to some important precisions. Private insurers, it is important to understand that private insurers are in the business of transforming uncertainty into risks by means of risk sharing, transferring, and spreading through the commodification and the securitization of risks, either of risks of death, disability, diseases, liabilities like medical malpractice, consumer product malfunction, car, prescription drugs, etc., corporate governance in the case of directors and officers' liability insurance, but also of accident, whether industrial, technological, ecological, or risk related to lending, financial products, etc., etc., etc. In that sense, I tend to believe that, at least in principle, all risks are insurable, and that the limits of private insurability are essentially defined both by the dynamics and mechanisms of capital accumulation and by the political will to allow and design diverse state interventions, regulations, and collaborations. That being said, let's move to this case study of terrorism risk insurance. It is extremely, in my mind, it is extremely illuminating. Since, according to Erickson and Doyle, not only did the insurance industry's risk governance has enabled terrorism risk insurability before 9/11, but it also ensured it to re-expand after the facts in a context where insurers were facing, let's say, a fear of the contraction of insurability, a dynamic analogous to the contraction of liquidity or credit crunch that has followed the 2008 crisis. Paradoxically, terrorism risk insurance markets produce enormous profits since loss probabilities are extremely low and contracts involve huge amount of capital stemming mainly from real estate. So I will show that this controversy has shed light on 4 ways in which the industry ensures terrorism risks insurability. 1, precaution, 2, prevention, 3, state collaboration, and then finance and securitization. And just to make myself clear, it is through this case study that I think that we can approach the insurance industry with the capital as power theory. So concerning precaution, in a high degree of uncertainty, the insurance industry takes in consideration the precautionary principle. I always have trouble with this word, precautionary principle, in the construction of insurential knowledge and risk modeling. Thus, aside from actuarial techniques, insurers measures risks by virtue of any other useful form of knowledge one can think of. That is, history of terrorism, expert subjective opinions, common sense, speculations, etc. They also started to include more seriously the worst case scenarios in their probable maximum loss models, as they call it. Secondly, preventive management of risks through security and surveillance technologies, as well as individual responsibility enforcement, have increased. After 9/11, as Erickson and Doyle show, insurers started imposing, through insurance contracts and also through more informal ways, private security, surveillance technologies, and enhanced urban planning to their clients. In this way, insurers are transferring the cost of preventive risk management to the insured and to society. In other words, the industry thus promoted, among other things, individual responsibility. As Erickson and Doyle explains, and I quote, the insurers effect moral regulation by making people think of risk subjects in terms of their own ethical conduct with respect to those objects, being knowledgeable about risks and doing their part to prevent, minimize, and distribute them. Third, for the industry, the state is not only a regulator, but also a market maker and an insurer in last resort. So first, before 9/11, numerous private insurance policies against terrorism were already mandatory in some jurisdictions like New York, according to public compensation schemes regarding occupational accident. And since 9/11, insurers have been legally constrained to reconfigure some conditions in terrorism risks insurance policies. Thus, indeed, this is why we can consider the state as not only the regulator, the market maker, but also the insurer in last resort. Because even though in the case of a terrorist attack happening, the markets still have the confidence that the state will bail out the industry anyway. So finally, concerning terrorism risk insurance, Erickson and Doyle also suggest that it is a story of how, in conditions of extreme uncertainty, insurance have difficulty forming a market and seek to help the government, and seek the help of governments as the insurer of last resort. In fact, the state creates insolvency funds, either with taxpayer money or industry contribution, depending on regulation in given jurisdiction. In this way, the state can prevent bankruptcies, or at least wants to prevent them, while at the same time increasing the limits of insurability. And this is the fundamental point. And finally, concerning the findings that came out of this controversy, the role of finance and securitization. Insurers can cover catastrophic risk by spreading highly uncertain risk through reinsurance and other derivative financial market and products. So after 9/11, insurers were facing the fear, as I said, of a contraction of insurability. Furthermore, the year 2001 was right in the aftermath of the dot-com bubble burst. So against the excess of uncertainty, the insurential governance, however, developed 2 risk-spreading solutions: investing in financial markets and securitizing catastrophic risk in the reinsurance market, which are secondary insurance market. I will maybe focus on that later. So on the one hand, Erickson and Doyle explained that the insurance industry addresses uncertainty by protecting capital from risk. Ironically, it does so by putting capital at risk, especially but not exclusively its own. End of quote. Insurance firms are indeed big speculators, and they can go as far as putting their own solvency at risk. Interesting example here is the growth in earthquake insurance policies at the end of the 1990s in BC. So based on the fear of an earthquake that is produced by this cultural image of the West Coast and the American West Coast being prone to big earthquakes, the industry sold too much earthquakes that if an earthquake actually happened, it will be unsolvent. This market, according to some experts, has decreased since the beginning of the 2000s. So anyway, yes, on the other hand, finally, the uncertain and speculative risks are, thank you, being distributed in reinsurance market in order to increase risk spreading. In reinsurance markets, the originating or primary insurer takes out its own insurance protection with reinsurers in order to spread its risk exposure. This financial sector, again, has grown rapidly since the mid-1990s and parallels the evolution of other financial markets for derivatives products, in which, for instance, the subprime mortgages have been securitized and speculated upon by banks and speculative funds, with the results that we all know. As Philip Bougen, another analyst, explains, the securitization of catastrophic risks, or cat bond, as the industry called them, in the reinsurance and financial markets will involve, for the most part, participants with a mentality of investing over the shortest of time horizons, worrying if a single catastrophe, itself a phenomenon outside of their normal range of expertise, might occur. So, okay, I will show this figure. It's pretty murky, but it can help at least me to understand what I'm doing. I hope it can help you. Now you get it, why I said it's murky. So basically, if you can understand, let's say, three things, is the interrelations between the primary insurance market, that is insurance that comes from individuals, households, collective institutional insurance, corporate, commercial, industrial insurance. And then the primary insurers have to hedge risks or invest, depending on how we want to put it, not only in reinsurance markets, but also in financial markets globally. First thing. Second thing, the important thing is the construction of risks that also differs. The closer you are, in my opinion, to primary insurance market, the more the construction of risks is based on actuarial and probabilistic knowledge. But the more you move towards financial markets, the more the construction of risks lies on financial and speculative mechanisms. And thus, in my opinion, the liquidity of the insurance capital increase the closer, obviously, as you all know, you are from the financial markets. So that's about it. Yeah, maybe finally, the interesting thing that the sociologists and critical criminologists has found through their ethnographic studies is that insurance exert, as I just explained, power as governance outside the states through responsibilization, social control, security investigation, and this is interesting, they often employ former policemen to privately investigate the insured, deceptive selling, and sales fraud. So that is this murky figure. So hence, we could conclude that in its most basic or pure sense, insurability can be defined by, one, the profit motive or the dynamics of capital accumulations. Two, the existence, the sole existence of a legally recognized contract. And three, state regulations and collaborations. All that, and this is fundamental, without any systematic consideration for scientific risk knowledge. In other words, Private insurance is in the business of fear and of judgment of probability, since radical epistemic uncertainty, not calculable risks, constitute its fundamental conditions of necessity. So, still have a lot of time, but in order to conclude, but it's an open conclusion, obviously. 2 points. As I just mentioned, interestingly, the first systematic, critical, and let's say heterodox studies of private insurance have been produced by socio-legal studies interested in the gap between law in the books and law in action, but also by critical criminologists and ethnographic institutional sociologists interested mainly in the relationship between power and knowledge and in white-collar crime, fraud, deceptive selling. So for the most part, these perspectives have approached, thank you, insurance as governance, that is, as a form of power beyond or outside the state, hence the strong Foucauldian influence. And two, finally, why capital as power, in my opinion, approach offers a solid foundation for a political economy of the insurance industry. On the one hand, in my view, qualities of insurance capital accumulation appear obvious thanks to those perspective, mainly qualitative perspective, since we can suggest that the insurance industry use a lot of techniques to pre-order reality, as I mentioned, through responsibilization of the individual, social control, private investigators, the imposition of security and surveillance technology, as well as urban and infrastructure design and planning. But also, and this is well documented, the industry is characterized by institutionalized strategic sabotage in the capitalized power terminology. So first, institutionalized market misconducts such as fraud and deceptive selling, mainly due to commission selling system, high labor turnover rate, managers and agents capitalizing on their families and friends, all leads to some forms of sabotage. But also, I would suggest that there's another form of sabotage of insurential mutuality and solidarity, by means of demutualization and depooling of risks, I explain, by virtue of two techniques. First, risk classification, that is, private insurers, in order to ensure profit, differentiate their insured pools according to the level of risk in order to diversify premiums level and thus the offer of different products. And two, they use risk deselection, that is the exclusion of certain consumer altogether. For instance, due to relative cost of property and car insurance in poor neighborhoods. So try to insure your car in really poor neighborhoods where there is either speculated or objective high rates of robbery. Insurers will charge you more money. So, and on the other hand, finally, in a way, quantification through risk calculation and risk management is at the core of the insurance capital's modes of power. In condition of radical epistemic uncertainty, in the Keynesian sense, actuarial probabilistic quantification appears as a powerful mode of legitimization in the hands of insurance capitals, again, as we've seen, despite a fundamental lack of scientific knowledge. But as you will probably suggest, answer to me, measuring insurance capital's power, its capitalization, its dynamics of differential accumulation, its ownership structure, and their historical evolution remains to be done. And I think I need some help, so that's why I'm here. Thank you very much.
Thanks a lot, Mathieu, for this interesting contribution, and thanks that I don't have to write 2 minutes warning, so we have a lot of time to discuss. Yes, questions, comments, remarks.
Thank you, Matt. And I think you outlined a lot of interesting qualitative aspects of how the insurance industry operates and ways that are sort of unexpected. I think it's important to document that what is sort of vernacularly understood as a very conservative realm of the political economy in its relationships with securitization is really anything but, and how it put lots of systems at risk. I would suggest that this is all very ripe for quantitative analysis, and I think documentation of the differential gains and losses of the insurance industry, its redistributions with other members of dominant capital, corresponding to events global and local of all manner, looking at the industry or the business in aggregate and disaggregate components of it, it would greatly enrich this account, and I think Capital's Power offers a lot of really useful tools to do that. So I would encourage you to do that, and there are many people in this room who would be more than happy to help you if you don't have those particular skills, and they're quite easy to pick up. And if you do, I look forward to seeing where you might take that.
Thank you.
Would you prefer to answer?
That was my answer.
Okay.
Thank you, Matt. I have a very brief question. The answer might be long or short. In your view, is the insurance business, I use business rather than industry here, how is it different from other forms of business?
I was expecting you guys to tell me. Okay, first thing, the material, say, manifestation of insurance is a piece of paper. Nowadays might not even be on paper, but still it is a policy. It is a promise of future indemnity in case of accident, catastrophe, etc. So in that sense, it is not based on any productive imperatives, even though it is still essential to any kind of productive industries. By which I mean every business, every entrepreneur, every industry needs to buy insurance. Not only households, not only individuals, not only institutions, other institutions. So it is, I think, the question. It is a really good question.
Maybe I can follow up on that, given your answer. And perhaps you can think of insurance as a way of conceptualizing the average, because insurance deals with every possible business activity and increasingly with many different forms of life or aspects of life. And what it does is tries to characterize those aspects of life in order to eliminate the uncertainty or to reduce the uncertainty and replace it with the appearance of probability. So essentially it creates normal distributions or other forms of distributions wherever it can. It generates what society considers normal, and it generates the tails of the distribution. So in a way, it is an entry point for understanding the normal rate of return or normality in capitalism. And that's why I'm asking this question, because it's interesting always to explore a particular sector, but it's doubly interesting if that particular sector actually is different from other sectors. So one way for you to make more specific your analysis is to think what is unique about insurance. And you don't have to find 10 different things that are unique. It's enough to find one thing and to concentrate on that and see if you can actually tease out something really important, say, with respect to capitalization or with respect to the overarching perspective of power. Because one aspect of power is to try to look at the future and say the future is really unknown, but is not entirely unknowable, or at least we want to persuade ourselves that it's not entirely unknowable. So Keynes would say we can't say anything about the future that is definite, because it's not like throwing the dice. You cannot find out what the outcomes are going to be, and you can certainly not assign probabilities to them. Well, that's exactly what the insurance business tries to do, and tries to persuade itself and others that it can do it. And in the process, it mechanizes society. And I think that that's the most important thing, in my opinion, about insurance from the moment go, you know, from London, where they first tried to estimate with statistics the population of London and things like that. It was always a power thing, and statistics come from the word state. Mm-hmm. So all of those questions, I think, feed in at the sort of highest level of analysis into the notion of capitalist power, and maybe you can make use of this.
Thank you.
Since there was nobody else, I just have a question. This particular situation that you described, I know you said that you hadn't done the evolutionary or historical part, but are you describing the contemporary situation, and is that substantially different from even 2 or 3 decades ago? Behind that question is this what we're seeing here a function of deregulation? Or hasn't insurance in particular as a sector always been heavily involved in pre-ordering? That was...
Those are really good questions, and I will try to work hard to answer them. Thank you very much.
What in the future?
Yeah. Obviously.
I'm sure you can make a stab at it.
Since I'm new to this capitalist power approach, my initial intuition is that, as I just mentioned, the growth in the use of securitization by insurance industry has especially started since the mid-1990s, which is also for some regulationist analysis, the consecration or the beginning of the true domination of finance capital in their words. So that leads me to think that it has transformed in line with other let's say trend in financialization. But as I said, for now, that's the only thing I can't answer. For instance, one empirical proof of that is the emerging of secondary markets for life insurance. So, especially in the United States and UK, some people are beginning to sell their life insurance indemnity to the insurance industry, which create, similarly to the credit securitization, some secondary market for securities on life insurance. So this is an innovation that appeared in the 1990s again, but yeah, that's it.
So.
Yeah, thanks, Matt. I've always thought that this is one area that really needs more research from a power perspective. Just connecting maybe to what Troy said earlier in terms of the empirics, and you might not have any idea about this. I'm just asking it out of curiosity. But first of all, who are the main maybe within the U.S. in terms of the primary insurance market, and also, and this connects to the empirical question, do you know if, in terms of the major players, if the trend towards conglomeration and amalgamation, if that's complicated things at all? Because I know if I go online and buy travel insurance, I buy it from RBC or from BMO, but we know in the finance industry in general that a lot of people are now doing finance, right? Like Herman talked about GE doing GE Capital and having its own financial wing. So is the insurance market itself becoming conglomerated, and are there different supposed real sector players that are now offering insurance and that type of thing?
Okay, Interesting question. First problem with the current empirical data we have is that it's mainly qualitative ethnographic research, which imply anonymous respondent and interviewee. So this is an important lack. That being said, for instance, I started to look a little bit deeper into the empirics of, let's say, AIG. And for instance, they have a big branch that is called International Leasing for Aviation, and whatever the name of their branch, which is involved in aviation. So the market for aviation insurance must be extremely huge. I don't have any figures there, any data. Maybe also, it is a really highly concentrated sector. For instance, I think in Canada, 80% of the market is controlled by five conglomerates like Desjardins was the fifth. Obviously, you got Power Corp, which has Sun. Anyway, so it is obviously a highly concentrated market, which was one of the intuition I had when I was reading Capital as Power. Thank you for.
No more questions. We have time.
Another possibility for the quantitative analysis is to look at the purchase of or the spending on insurance by corporations, because it will often be listed in their various reports how much they're spending on that in particular, and you could look at that spending, compare it to what's going on in the insurance industry, and then the identifications of risks by those corporations, because in their annual reports they very explicitly have to lay out what the potential future risks that they face are. And I've always thought that that was an area that needed a lot more analysis.
Thank you very much.
So I have a question myself. In your subtitle, there is, you write, between Veblenian institutionalism and the theory of regulation. You told us something about the latter, but how will you Veblen bring in?
As I pointed out in my conclusion mainly, and this is also something that I was testing, how I can call these institutionalized practices strategic sabotage as Capital as Power understands it. I am not sure. So deceptive selling and fraud commission selling system, and I think those two phenomena are really important. Risk classification and risk deselection. So that is how I was suggesting we could look at the insurance business through Capital as Power approach. But I'm not sure if we can call that really strategic sabotage. That's what I was suggesting. Because in a way, another hypothesis, working hypothesis for me, is that there are some alternative legal forms of insurance, like mutuals, which are often financial groups in reality, but still there are some more, say, democratic and ethical forms of insurance business, and government insurance. So a comparative analysis of the corporate form and the alternative form might also help me to see if if there is truly strategic sabotage in terms of efficiency, risk classification, solidarity. So that's one way. And pre-ordering also, since the insurance imposes its power through various forms of governance. Even, and the works of Erickson and Doyle suggested that, even the urban planning in Manhattan has been negotiated between states and the industry and the industry associations. So this is, in my opinion, a form of pre-ordering. That was my suggestion.
Oh, any questions, comments left? Thank you.
Thank you very much.
Mathieu.